Thank you for tuning in. I'm Eric Griffin, President of iTeam Trading, and this is Lynette Zhang, our Chief Market Analyst. And we are going to ask her questions live on air.
Okay.
So, Jay asks, when silver was approaching $18 spot price in the spring, I attempted to unload some ounces at a local shop. But they had such a large volume of silver that they weren't offering spot rate buyback pricing, but instead giving me a rate of $3 less than market value per ounce. In a collapse scenario, what's stopping shops, markets, etc., basically anyone and everyone from naming their own price when it comes to precious metals values?
Well, actually there's a few different questions in there. So I will say, number one, in a true supply-demand market, that's actually how prices are set. Not by a government saying this or other kinds of manipulation. Since gold and silver are universal, and they hold value because there is always demand for them, and especially with gold, since that is the metal against which resets are accomplished. They revalue the currency against gold. Not saying that you're going to get exactly this or that, but depends on who you're going to liquidate it into, whether you're going to liquidate it into a store for food, in which case you'd be using silver, or you're going to be converting it into a piece of real estate, because understand that at that point, nobody's going to want the currency. They're going to be so well aware that the currency is collapsing that they want something that's going to hold value. So that's definitely one way to answer that. Another way to answer it is, and what we do here really, because we've been in business since '95, so we have a lot of long-term customers, and everything that we do here is standardized as far as the bid-ask buyback spreads and what have you. So we are not going to give you a different price. So it depends on who you're doing business with. If you're just randomly walking off the street to some place, well, their job is to buy it as cheap as they can. But if you're working with a reputable dealer and you have a long-term relationship, then their job is to support you. And so, of course, things are going to be more standardized and different. But it depends on who you're working with.
Yeah, and clearly, Jay, you experienced a true supply and demand functionality. I mean, they had so much supply, you said it right there. They had such a large volume that they weren't offering spot rate because it's a lot easier for them to go, well, we've got all this silver that's already sitting here, we'll give you less. But doesn't mean you probably, my guess is, didn't liquidate it there. You probably went down the street and said, how much will you give me for this? And it'll be the same thing in a collapse scenario.
Well, yeah, but the reason why you saw me doing this is I just was, in fact, I don't think I'm going to use them tomorrow, maybe not this week. But in the most current issue from the World Gold Council, where they were talking about, supply and demand issues, what you're really referring to in there is like the secondary market, and the supply, the new supply coming on the market did not surge, even with spot silver at $18. In fact, that was one of the big comments. So I'll show you that this week. But that was one of the big comments, that supply did not surge even as prices went up. And it was, a shocker. Well, so I think that it's more, most likely in those circumstances, it's the dealer knowing that you don't know what you're doing really, and you don't have all of your support systems set up around you when you're working with precious metals. So, hey, they're gonna pay you whatever they can get away with, whatever you'll accept. So that's not necessarily so, but it could very well be so.
Well, let's pretend like these people aren't trying to be sinister or whatever.
Well, I'm sure they're not trying to be sinister.
I get this when I sell to the wholesalers. If they have a large volume of something,
right,
they'll tell me, well, we have tons of those, so I'm only going to give you a melt for it, right? So versus maybe it would command usually a $2-3 above spot premium. So, that really is a true supply and demand situation.
It can be.
Mm-hmm.
That's what I'm saying. It is not necessarily always accurate. If you're doing business with us and you want to sell it locally, if you give us a call one of the precious metals consultants, they'll give you a bid. They'll tell you what the market will bear. Then you can make that comparison. You know, hey, is this person just trying to rip me off, or is it a reasonable and fair price? So I'm just not good at taking anybody's word for anything. I'm sorry. I came across that the other day too. You know, it's like, show me why. Show me. That's all my work is. Here, I prove it. I prove it. I prove it. Follow the links. So, yeah, I would have wanted them to prove it to me.
To prove what?
That's really where the market was. And one way they could is by calling up a reputable dealer and getting a real bid price from the wholesalers that have a broader network. And then, if you have possession of it, you can sell it wherever you want. But then you have a baseline, right?
Yeah, well, I'm sure he did that. I doubt he sold it to him for less than $3. I'm sure he probably went someplace else.
He might have, or he might not have.
So David asks, when our dollars reset, are they going to print a new-looking dollar?
Not if they take us all digital. They won't have to print a new-looking dollar.
But typically, if they didn't,
no, it won't be a new-looking dollar.
It's
same? Been it's very close.
Have a bunch of zeros every time they add, right?
Right. Well, you'll just be you're talking about getting bigger and bigger bills. But when you actually look at the gold certificate and the Federal Reserve note, back in 1913, they look very, very similar. And you couldn't really even tell the difference between the $20 bill prior, to August 1971 and the brand new one that they came out with afterwards. I mean, seriously, all pretty much identical. So what they try and do when they're making a shift is keep things appearing as normal as possible so that they make the shift and you don't know it. So no, they would not, whether it's digital or they come out with another, hopefully we can keep cash, they come out with another bill. The bill will most likely look very, very similar to the old ones.
All right, so Tortoise62 says, isn't it true that bail-in languages addresses higher balances?
Well, I think what he's probably referring
FDIC.
to is, right, and not just here, I mean, because that's a global blueprint, but yes, the deposit insurance scheme. That's not my word. That's actually the banker's word for what they're doing. And they tested that in Cyprus, where they were not going to honor the deposit insurance, but globally everybody went, the deposit insurance. So they did indeed back up and then honor that. But then after that, the Bank for International Settlements, in their blueprint, they gave you what it would look like over a weekend when they did a bail-in with or without deposit insurance. So both ways. And then we know more recently, the ECB was talking about doing away with it or reducing it, or so that's a scheme. That's what it is. In fact, I just pulled the diff balance. They've got 0.013 pennies to cover each dollar's worth of insured deposits. I just pulled that data.
Yeah, so
Monday.
So basically, we don't know. They could
honor it
or not.
But even when they honored it in Cyprus, you still didn't have access to the funds in the account more than a certain
per dollar a day.
Right.
Yeah.
And even if all of it was honored, inside of what we're talking about, the value of it is declining so rapidly, who cares? That's not a place to store your wealth and keep it.
Mm-hmm.
So lots of things about that.
All right, so Beowulf says, if gold goes to $5,000 an ounce and silver to $200 an ounce, as suggested by many, is the increase in value because the metals actually have increased, or is it an indicator that the dollar's value has dropped and it takes more devalued dollars to buy that metal?
Yes. Number 2, the second part of that. That's exactly the answer. Same reason why you see spot, even though it got hammered today, at, you know, $1,200, $1,250, wherever it happens to be at the moment, versus $20 like it was originally. You know, that's an indication of a failing currency. And if it was allowed to go to its true fundamental value in terms of dollars, it'd be an awful lot higher than it is. So you're even looking at the manipulation of that. And even so, you know, it's not $20 an ounce anymore.
Yeah. All right, so Larry asks, if the Fed is printing all of this money, who is the beneficiary? Whose account is it going into?
Oh, good question.
Who benefits from the trillions in their pocket?
Well, whoever is closest to the new money printing, because at the moment that it is created or the moment that you get it into your hands, it has the most value that it will ever have. So who's closest to the central bank?
The banks.
Exactly. You know, when our government borrows money from the central bank, they don't borrow it directly. They go through the commercial banks to buy the bonds, giving a profit to the private bank. So it is first, and also when you stop and think about it, those private banks, when they borrow from the Federal Reserve, they have better interest rate than anybody else, including the federal government, because we taxpayers are obligated to repay that. So it goes, central bank is where the money's created, then the next spoke are the banks, then it's not just the banks, it's the private corporations, then it's the government, and you know, you and I are out here.
Right.
So yeah, whoever's closest to the bank benefits because they get to use the money when it has the most value. Looks like he's reading.
Yep. Checking out, see if there's some other questions that we want to ask. YDLP Silvi. Is it recommended that we have enough emergency money saved for 6 months to cover all of our expenses in case of loss of employment?
Mm-hmm.
Yeah, you think 6 months?
Etc. Well,
Ish.
I think it really kind of, you know, depends. You definitely need a certain amount of cash. So that's the kind of question that's kind of customized. I mean, if you are retired and you have very limited, you know, circumstance and what you have the ability to do, then maybe 6 months isn't quite enough.
You need more cash.
You'd need more.
But if
Exactly.
you're working, maybe less.
Right. And if you're younger, so, you know, that's really, well, we can talk to your precious metals consultant and kind of get a feel for your circumstance, because that's built in the formula to how much you need. And then, of course, it's up to you. But a basic formula and how much you need, that's part of the strategy, how much cash. And in what form and all of that. So it depends.
In what form? Does this mean keep that in fiat in the bank?
That would be a no. Okay, now you need enough in the bank to keep your accounts open. You know, a lot of people have auto deposit, auto withdrawal, and that is still our tool. Exactly, that's still our tool of functioning. So I'm not saying that you close out and you don't have any bank accounts, but I could tell you on a personal level, I don't keep very much more than what I need in there, because I know at some point I expect there to be a bank holiday, and I'm going to be limited to my access. I feel like I can always, at least at this point, I can always make a deposit, but I can't always make a withdrawal. And they have been for a number of years making your opportunity on how you can pull money out of the system more and more and more limited. Over the years, they've been reducing those options. So, you know, like right now, they make you feel like a criminal if you go and you take cash out. And they've trained, you know, like the tellers and at the banks and at the brokerage houses, well, what do you want the money for? And, you know, they make you feel like a criminal. But at this point, it's not illegal to go and pull out however much cash that you want. You may need to give them notice because they don't carry a lot of cash. So I would honestly say that it really does depend on what your circumstances are. So, you know, give us a call and, you know, talk to your precious metals consultant. They can help you determine what's right for you and where and how to hold it. Because that's all part of the strategy, all those pieces and parts.
903 Boater.
Ooh, I like that name.
Yeah, I knew you would. Why can no one answer me on this? Why would we owe anyone anything for a worthless piece of paper? I say that we owe the central banks nothing. Well, the laws would say differently.
Well, okay, the way that I would answer that is the reason why we owe anyone anything for a worthless piece of paper is because connectedly we've all agreed that that worthless piece of paper has value. So even though I know that it doesn't, and you, Boater, know that it doesn't, that's still our tool of barter. So yeah, it has value. You know, why do a lot of these fiat products, why do derivatives have value? You can't even convert them into anything. They have value because a whole bunch of people agreed that they had value. Why are digital currencies going to have value? Everybody's got to agree. And that's the point of what we do here is education, because we want to retain some of our rights. So, I mean, I don't agree to giving up all of my rights.
But I don't know that it necessarily answers his question, because he says, I say we owe the central banks nothing. I don't think it's agreement with all of us that makes that so. I mean, we definitely know that there's laws that were put in place when the Federal Reserve Act was put in there. Right. That all those laws that were put in place say that we owe. And I'm pretty sure they even say, like, if we as the public can't pay that debt, then the land, collateral, and labor of the people will be used to repay that debt.
Yes, thank you. You're right.
Right? So, I mean, that's why. The people who put these rules and these fiat money systems in place, they insulated themselves.
Yes, but we also everybody had to agree. Now, we didn't know what we were agreeing to, but we still had to agree. Because in the beginning, money was sound money. It was labor and savings based. So when you traded your labor for a piece of gold, you were trading labor for labor. Then we went to where we were trading our labor for debt that we were obligated to repay, because that's the current system. Now, if everybody really understood that, what we agreed to work for, they'd probably say, are you out of your mind? No one don't agree to that. But because we didn't understand what we agreed to, I remember I was there when we went from at least a partially backed currency to a full debt currency. That means I was now working for debt that was accumulated on my behalf, but really not really asking me if this was okay with me. But on my behalf, I'm obligated to pay it back. Now, the direction they want you to go in, at least in theory, if it is a debt instrument, somebody owes somebody something. But the direction that they prefer to take us in means that nobody owes anybody anything. And you're going to agree to trade your labor for digits on a computer that have a contract that you didn't read. I mean, I got a problem with that. So yes, all of that legally stuff, 100% absolutely. But this is my battle. If people really understood what the point of money is, it's more than just a tool of barter. More importantly, it was intended to be a way to be fairly paid for your labor and a way to hold value of excess labor that you didn't need to use today. I didn't need to spend all that money. I could save this. Well, guess what? If I don't need it till I retire in 5 years, 10 years, 20 years, 50 years, 100 years, if I want to pass that labor on to my children, my grandchildren, my great-grandchildren, I want it to have the same value. Because my labor, I worked hard for it.
It's kind of crazy when you think, though, like how much the value of the dollar's lost since 1971, since we went full debt-based.
Yeah.
It's like over 80%.
Yeah.
That's a hard battle to... Anybody who retired then, if they're still alive, if they retired then...
On a fixed income.
Could you imagine? You can't.
You can't. They would be living under a bridge.
I was talking to my grandfather. Actually, he said he graduated. He retired from Honeywell in 1989, and he was on a pension, and it was fixed. It was not, there was no cost of living increases, and he said he could actually survive. Him and my grandmother could survive on that pension, and it would pay all their bills. And I asked him maybe 2 years ago, and I think he said that same pension doesn't even pay for 25% of their bills now. You know, so imagine trying to retire and then have 30 years left. I mean, you're fighting an uphill battle against the dollar.
If everything is fiat, right. And so they want things to look like they're going up in terms of dollars, but when the value of the foundation is rotting, right? A house can look beautiful for a while, but at some point, the whole house will collapse when the foundation is rotten. And that's what the problem is, the foundation of the whole system. And then how they have convoluted it and put more and more risk and leverage and debt and all of these, you know, I mean, as individuals, we know better than that, to take on a level of debt that eats every bit and then some of your income. So that even if you stop growing any debt, you don't go out, you don't shop anymore, your debt just keeps compounding? Come on. And your income doesn't compound with it? I was listening to the new Fed Chair Powell this morning, and I was listening to him talk about inflation and how they're really happy that they've finally met, you know, their inflation target, and that they're like thrilled to pieces because now prices for goods and services are going up, but wages are not really adding to that inflation. Well, who is that good for?
Right.
The corporations? And that's what people have to understand. So when you talk about holding money in the banks or this or that, they don't hold money in the banks. They gamble with it through derivatives.
Yeah.
Or they pay it out in different ways. It's not there for the next crisis. But your money is. I have a problem with that. A big problem with that. I think everybody should have a problem with that. And if everybody understood just that little piece, that this money, the banks are making more money, the corporations are making more money than they ever have. A lot of that is via that inflation piece, right? Because how do they gauge inflation? It's the cost of goods. And who makes the cost of goods? The manufacturers, the corporations, goods and services. So, you know, they're making more money than ever. They're getting all of these tax advantages far greater than the individuals. But when they pay those out, whether it's stock buybacks or dividends or bonuses or CEOs pays or any of those things, that money's no longer available if they need it in a crisis. They're not saving that. And that's what puts the whole entire system at risk, because at the same time they're doing that, they're taking enormous risks with their client base, you know, their depositors. You think they're making the most money ever on your deposits? I don't think so. There's not a big enough spread. They're not loaning enough money out. They're making it on these leveraged bets. And it was those leveraged bets that killed the system. Well, the long-term capital management, they knew at the end of the 90s how dangerous these things were. And then again, 2008. The next time there's no room on the balance sheet. Not say that they won't come up with something creative. I mean, I got to give them credit.
We hope you have a really fabulous day. On that note, with that news.
Well, just remember something. Shields are made of metal, not paper. Keep that in mind. So SGT was just released, so that's up now. And I did an interview this morning with Rudy, a very interesting guy, very smart guy, Alaskan preppers. And I think he said that would probably be out either tonight or tomorrow. But, you know, just contact us through all the social media. Make sure you subscribe. Make sure you share this with everybody. If you like it, give us a thumbs up. Tomorrow, I am going to be talking about the decashing of society, basically.
Going cashless.
Going cashless, and why it matters to you. What do you care? Most of your transactions are probably cashless right now. But it's really about privacy, autonomy, and control and independence. That's what it's really about. So I'm going to show you some things from the IMF and the BIS and, you know, all the usual guys that I think you're going to find really, really interesting. And then on insider trading this week, I'm going to show you something in the markets that has me, you know, actually really concerned. So I don't want to, but I'll either talk about that tomorrow or Thursday, but one or the other.
Okay, perfect.
Okay, so I guess that's it. Please be safe until next time. Bye-bye.